Time to see what's on the radar. We're back with Allan Small, Senior Investment Advisor at the Allan Small Financial Group at IA Private Wealth. And you've got quite a few stocks, and one people haven't talked about in a while, because renos were the big thing during the pandemic, Home Depot.
Yeah, it's a name that I think is very obviously tied to the housing market, but very much tied to interest rates. And as interest rates come down, I think that's a good thing for obviously a name like Home Depot. Talking to a lot of home builders, not a lot of homes being built right now as yet. I know obviously the budget just came out. There's going to be a lot of money set aside for building. But what I am starting to hear is that the rental market is kind of being revitalized. And we're seeing a lot more action in the rental market. And who better to capitalize on that than a Home Depot? The stock is down, trading in and around $370 per share, off of their highs of about $420, $430. I think it's a name that can definitely gain some momentum as interest rates continue to fall. And I think they will, especially come the new year in the U.S. with more of a dovish head of the Fed. That's what we're anticipating as Jerome Powell leaves and the president puts in a new person who will be more likely to cut interest rates and perhaps even quicker. So I think a name like Home Depot definitely works and not too expensive right now, still has room to run. And it's a name I think you can add to a nice diversified portfolio.
Okay, and let's move on. And we've got Scotiabank. We have another one we haven't really talked. Banks. We're waiting for their earnings reports coming out soon. Yeah,
big earnings reports. I think that's going to be definitely a market mover for us up here in Canada. Obviously, banks making up the largest component of the TSX in around 25-30%. Scotiabank is interesting because, number one, it's paying the best dividend right now of all the major banks. Just under 5%. It was once upon a time yielding 5-6%. But the stock has had a tremendous run off the lows in the high 70s, now in the low 90s. Perhaps it can even get up to the $100 mark. Obviously, Scotiabank, a big restructuring, new management, new CEO. It's just fantastic. The results have been fantastic. I look forward to Scotiabank continuing to see their price continue to move higher. Not that expensive. Cheaper than some of the other big names like Royal and TD. So, yeah, it's the name that I've been gravitating towards. Again, I would say more than likely because of the higher dividend yield, I think investors will look to that name more so than others.
Okay. What do we get next? Shopify, which had a great report for the most part, and yet still took a little bit of a hit, but it's still worth it, you think?
Well, I think Shopify, actually, it did take a hit, and I think it's because of the expectation, right?
Yeah.
Shopify, Celestica. These are names that live in the AI world, and these are actually names that I have not added too much as recently. They're actually names that have been trimming some of the profits back and still holding them, but trimming some of those profits back because, for example, a name like Shopify and Celestica, they've just gone up by so much. Celestica, it's unbelievable the run it's been on. Shopify near all-time highs once again. How much further can these names go? Both of them trading quite high. I think Celestica 50 times forward earnings, just outrageous. And Shopify as well, trading at a very high forward earnings multiple. And so can these names grow into their earnings? Well, I think it's going to take a little while to do so. So for me, I would probably be a holder of these names. I wouldn't add more and maybe trim some of the profits if they continue to move higher.
Okay, I'm going to get one more in before we're out of time. Enbridge reporting today with strong third quarter results.
Yeah, Enbridge, a name I've loved for obviously quite some time. I think a lot of Canadians buy Enbridge for the dividend yield, right?
Yeah.
You're looking at a dividend that's just under 6%, a name that's also giving you some growth, as you can see in the chart. Recently, it's come down a bit, so dividend yield back up to close to 6% again. At one point, it was in the low fives. Trading not that cheap. Enbridge trades somewhere around, let's call it 22 times earnings. To me, again, I think it's not a name you're going to buy if you're looking for growth. I think it's going to be a name in your portfolio for the dividend income primarily. If you get a little bit of growth, that's a bonus. But a name that they just confirmed, as we said this morning, their earnings outlook going forward. So I think if you're looking for some paying 5-6% dividend yield, that's the name that fits the portfolio.
And that yield, it's the yield you like on these ones,
It is, definitely.